coming to our latest seminar in financial literacy. I believe this is the first one we've actually done on investor financial literacy. So here with us today we have Mary Head from the SEC and Seth L from the Library of Congress. So Mary's the Deputy Director of the Office of Investor Education and Advocacy at the Securities and Exchange Commission. The Office of Investor Education and Advocacy serves individual investors, ensuring that their problems and concerns are known throughout the SEC and are considered when the agency takes action. Investor assistance specialists within the office answer questions, analyze complaints, and seek informal resolution of investor problems. The office also publishes free brochures and other educational materials on numerous investing topics. Now, Mary joined the SEC in 2000 and served as counsel to 3 successive SEC commissioners. She joined the Office of Investor Education and Advocacy in 2008 as Assistant Director and became Deputy Director of the office in 2009. In that capacity, she focuses primarily on policy matters relating to investor protection. Before joining the SEC, Mary practiced securities law at 3 different law firms. She received her JD from Catholic University Law School and her BA from Yale University. Now, Seth joined the Federal Research Division of the Library of Congress in December 2002 as a Senior Research Analyst and became a member of the permanent staff of the FRD in September 2004. Prior to coming to the library, Seth worked as an analyst at the National Security Agency, as a computer specialist at the National Library of Medicine, and as a financial analyst at Friedman, Billings, Ramsey, Inc. Seth holds an AB in German Literature from Princeton, an MS in Computer Science from the Johns Hopkins University, and an MBA in International Business from here at GW. His areas of specialties include European Studies and Finance, and he is a foreign language specialist in Russian and German. He has written articles for Kiplinger's Personal Finance and Community Banker magazine. So we're going to start with Mary's presentation. We'll have a few minutes for questions right after her presentation. Seth will take over, and then we'll have a longer period for questions at the very end.
Before I begin, I have 2 disclaimers to make. First, the views I express today are my own. They do not reflect the views of the Commission, the Commissioners, or the Commission staff. And secondly, the study that we're going to discuss today is an SEC staff study. That means that the Commission has not passed on the analysis or the findings of the study. Today's presentation, I'm going to begin with a brief review of the requirements of Section 917 of Dodd-Frank, which mandated the study. I'm going to briefly go over how we approached each of the 6 different tasks that we were given under Dodd-Frank, and then highlight some of the selected findings. In 917, Congress asked us to identify the existing level of financial literacy among U.S. retail investors and to identify ways to improve it. What you see here are the 6 different assignments, the existing level of financial literacy. 2, 3, and 4 are we grouped together. 2 required us to identify methods to improve the timing, content, and format of disclosures to investors. The 3rd section required us to identify the most useful and relevant, understandable information that investors need in the process of engaging a financial professional and purchasing investment product or service through a financial professional. And then 4th is the 3rd of this subgroup. We had to look for ways to increase the transparency of expenses and risks. The 5th assignment was to look at existing investor education programs and identify not specific programs, but try to find the characteristics of the best ones that we found. And then lastly, in coordination with the Financial Literacy Education Commission, to try to find a strategy to improve investor financial literacy with measurable goals. The first part of the study, the existing level of financial literacy, we did not do ourselves. We contracted with the Federal Research Division of the Library of Congress. We The reason for that decision was that we wanted to use the budget allocation we had in areas where the SEC could move the needle, where our data would provide the foundation for possible future SEC rulemakings. So now let's look at parts 2, 3, and 4. The issues presented there seem to call out for investor testing. We hired a contractor, Siegel & Gale, to do investor testing. And they designed a two-part strategy: qualitative research in the form of focus groups and quantitative research in the form of an online survey where investors could be presented with documents, be asked questions about them, and then possibly compare documents. So in the focus groups, we chose 3 locations: Baltimore, Atlanta, and San Diego. We were 2 nights in each city. The first session each night took the participants through the process of selecting a financial intermediary. And by that I mean a broker-dealer or an investment advisor. Financial planners were included as well. And then the second part was to take them through the experience of purchasing an investment product through a financial intermediary, through a broker-dealer or advisor. And to do that, we formulated the focus groups in terms of a mix of products. So the first session each night was on the first topic. The second one, we mixed owners of mutual funds, variable annuities, some nights bonds and ETFs. We had a broad cross-section of financial products. And we were looking for these particular disclosures about fees and costs, risk, conflicts of interest, formatting, and delivery options. The criteria for being a participant in the focus group were that the participant had to be the sole decision maker in the household or share financial responsibility, to have owned certain of those products, and then we had a mix of genders, ages, and educational levels. The highlights of the focus group, I would say, were number 1, timing. Right now, and I will, as we go through the online and we go through the branch that tested each of these documents, I'll explain what the document is, when investors receive that, and what the content is. But for the focus groups, we asked them a series of questions. They overwhelmingly wanted to get investment disclosures earlier than they currently do. They want to get them before point of sale, so they have time to read them, understand them, and formulate questions before they come to the point of engaging the financial professional or making the investment decision. They were also interested in the visual improvements in the documents. They prefer, briefer, they prefer bullets, charts, various visual tools to make the key information stand out. Overall, as to content, the participants divided into 3 categories. One group was entirely satisfied with their relationships and with their disclosures. The second group felt that there was too much or not enough, but they had specific interests, usually performance and fees, that they looked at. The third group I thought was the most interesting. One of the participants made the comment that, and I'm going to quote here, "There's a bit of a diminishing value because the more that it is disclosed to us, we may be less likely to pay attention to it." So somewhere they've got to decide the tipping point when people are just going to tune out because it looks like it's just too onerous. So this was a concept that we heard over and over. It's the balance between investors wanting a lot of information, but also wanting it to be presented in a very short, visually significant way. Here we had 4,800 participants in all. We had 4 branches, 1,200 each. The findings, our designed to be statistically significant within each branch. The criteria for being in the online survey were a little more onerous than the focus group participants. So these were the general criteria. Then in addition, depending on which of the next criteria they met, they were placed in a specific branch. So for the 1,200 people that tested the Form ADV, and I'll explain what that is, we needed to have their their assets invested of $50,000 or more, which was higher than the other groups. Then we asked them how they compensate their financial intermediary. And here you see us looking. It's generally known, I think, that investors are confused as to whether they're dealing with a broker or an advisor. So here we listed the various ways that they could be compensating their financial professional in an attempt to get them into the right group. For the other three subgroups, you had only needed to be $5,000 invested if you were under 35 and $10,000 if you're over. For the mutual fund people, you had to own those particular investments. And for point of sale, you needed to be, you need to have a brokerage account and be compensating your financial professional in one of those ways. All right, now this brings us to the first of the online survey branches, and this is to test the brochure. Let me just say a few words about this document. In 2010, the Commission changed the formatting for the responses that are required of investment advisors to give their clients before or at the time they enter an advisory relationship. Now, most of these items are really related to conflicts. Before 2010, advisors gave their investors sort of a check the box. In 2010, the Commission changed that to require a narrative format. So they were presented with this document. Some people did not know, don't recall receiving it. Some received it but didn't know the name of it. These slides begin to explain what the data was from the people who looked at the brochure. Time and again, the fees and disciplinary history are showing as the most important information. Now let me just say that the slides you see here in color are taken from the Siegel and Gale report, and that is an attachment to the study itself. So that's the source, not the SEC. Here, fees and performance, the most important factor in choosing an advisor. Disciplinary history being something they would want to know when they compare investment advisors before choosing one. And then this shows that that list of 18 items is somewhat intimidating, and that they would like to think about having a summary of the information in the 18 items. This was under a subgroup called a hypothetical brochure summary. We got a lot of different data on hard copy versus online. To me, surprisingly, high numbers of people who still wanted hard copy. But you see there, some of them, 27.2% wanted an electronic copy if they've agreed to receive it, whether through a combination of a postcard and with a link in it or what, but just having it on the website is not sufficient. Here, in addition to whatever brochure or brochure summary they get, they still want to discuss it with their investment professional. Now, even though they said that disciplinary history is one of the most important factors in choosing an advisor, it was relatively low usage of the SEC and FINRA tools for checking the background of your broker or advisor. This is a screenshot of the SEC's investment advisor public disclosure website, where you can go on there, input the name of your proposed advisor, and get the Form ADV itself for the entire firm and information on your the fees, costs, risks, etc. Surprisingly, few people knew of the existence of that, although a large percentage said that they would have used it had they known about it. So we need to do a much better job of publicizing and promoting the tools that are on the SEC website and FINRA website. All right, now at this point, the group was divided in half, and half were given this exhibit, which pertains to fees and compensation. The other 600 were given a similar exhibit about conflicts of interest. Now, generally, people thought they had a good understanding of a lot of these topics, but when they were asked specific questions, that broke down. So here you have disclosure of how fees are going to be charged. Can you read that? It's pretty small print. And then we followed this up with a question as to how, if you have $450,000 in assets, what fee would you be charged? And this required them to go back and look at that exhibit and try to figure it out. And unfortunately, only just under 30% got the correct answer. And this was across the board. Generally, people being overconfident in their understanding of the information in the disclosures. Okay, so here we're moving into the second branch that we tested, which was for confirmations and account statements. Now, you know that a confirmation is what an investor gets at or before the completion of the trade, which could be T+3. So they generally get it after they've bought or sold. Here again, this document gives you the name of the security, the capacity in which the broker acted, and the compensation to the broker. They were given 3 examples of this. One was for a stock transaction, the second was for a mutual fund purchase, and the third was for a purchase of a mortgage-backed security. They didn't do that well. On the mutual fund and the stock, they had pretty good scores, 50% plus, identifying the product. It was difficult for them to understand the capacity, meaning principal agent, or in some cases, a dual agent, or to know why that mattered. Principal selling to you from his own inventory, agent going into the market to buy the securities for you. And dual agent being he's representing you and someone else. And these 3 items, the price, the number of shares, and whether it was bought or sold, they viewed as being absolutely essential. And just notice that questions gave them 4 choices: absolutely essential, important but not essential, nice to know, and completely unimportant. So that shows the people looking at these documents and saying what is there and what isn't there. And what wasn't there was whether the securities were sold short. Now, that's on the order ticket, but it's not on the confirmation they receive. Now, here we've moved into the third of the 4 branches, and this branch tested the summary prospectus. If you are selling a mutual fund, you have to give the investor a prospectus before you deliver the security. And the statutory prospectus is a very long, lengthy document. It requires all of the requirements that the SEC mandates. And a lot of the time it includes the information on more than one fund in a single document. So in 2009, the Commission said, well, mutual funds, you can meet your prospectus delivery requirements by giving or sending to the investor a summary prospectus. And this was a much shorter document, maybe 2 to 4 pages, that permitted the funds to meet their obligations as long as, when giving this, the longer statutory prospectus was on the website. we do see, a good half of people saying that they read the statutory and then more reading the shorter summary of key information. In choosing a mutual fund, they look at the summary prospectus about in a quarter of the cases, and when they do, this is the information they look for: performance, costs, risks, investment objectives. Those are the top ones. Now, interestingly, we did a before and after, and so before they were shown a summary prospectus, they were asked about their impressions, and they were pretty negative. But then after they actually looked at a summary, the scores went up, so I guess that's good. Now we're in the fourth segment, and this is called the point of sale branch. Now, we don't have a point of sale document right now. The Commission has considered it in the past, but has not taken action. And in this branch, the participants were queried on how they make financial decisions. And you can see, relying on their professional, but still making their own decisions in some cases. And then these are the factors, and there's consistency in this data as to what factors that they consider important. The comparison between thinking disciplinary information is very important, but only having 15.9% of people check the tool that tells them about the disciplinary history of the person is not a new fact. That's been shown in other studies. Again, this is emphasizing that they want to have the information before they enter into a relationship, not at the time of, when there's not enough time to ask questions. There's the background information being important again. Various types of information about the disciplinary. Now, one of the most interesting things to me was in both the focus groups and the online survey, talking about conflicts in the abstract did not really resonate with the participants. But once you explain that the broker may earn more on one product than another for a variety of reasons, then they got quite exercised and wanted to know a lot more information. I mean, they didn't, some of them, half of investment professionals are selected on the basis of a referral from a family member, trusted financial advisor of some sort. And unfortunately, the analysis sort of ends there in many cases. So the fact that the broker could be selling to you out of inventory, or that he could get a higher commission on one product or another for a variety of reasons, really came as news to these people, and they were shocked. Just to try to sum up this whole area of how to improve the timing, the content, and the format, let me just say this. Clear preference for wanting the disclosures before having to make a decision. I mean, it seems common sense, but we don't have that in all cases. For example, you heard me say the Form ADV before or at the time of the formation of the relationship. The confirm after the trade. Summary prospectus can be after you've bought the mutual fund. And point of sale, we don't have one. On the content, just to repeat, those are the elements that the investor finds essential for the broker or advisor or the investment product. Format, clear, concise, understandable language, not surprising. The good thing here is the layered disclosure, and we do that with the summary prospectus, where you get the summary prospectus, there's the link to the longer, more complete document. And that satisfies the investor's desire to know more information, but not to have too much information. So if they can go as deep as they want to go, that seems like a pretty reasonable and doable thing. The factors that they would like to know before hiring the professional and before buying the product. Transparent expenses, they would like more narrative. Some preferred narrative with a table, others preferred just the table. It was a variety of preferences about that. And they wanted, on the trade confirms and the hypothetical point of sale document, more disclosure of the various ways that the broker can be compensated. In the advisory space, there was a vote for differentiating between the way the fund charges to operate itself and the way you pay the advisor for the services rendered. The timing of conflict disclosure, they would prefer to have it once at the beginning and then to be reminded when they get to the point of a transaction that involves a conflict. So now we're going to move on to the fifth of the Dodd-Frank assignments. And here we requested public comment. We got about 85 comments. Again, they're on the website, to tell us what they think works best in terms of an investor education program. And these are the factors: the research and evaluation. There are many programs that have a lot of content, a lot of materials, but their results aren't evidence-based, and so they don't use the results of one study to formulate the next study. So that really, and the ability to have goals in the second prong here helps the organizations focus on their priorities of their resources and also the target audience. This means that it helps if investors can connect what the investor education messages they're getting with teachable moments in their own lives. So if you're just starting a job, the thinking is you would be more likely to listen to an investor education message about saving and beginning to invest. Strategic partnerships, we try to do this. No one organization generally has the resources to do broad programs, and so we partner with many different organizations, and I think that was promoted as one way to increase the scope and effectiveness. Easily accessible simply means easy to find, easy to use, delivered efficiently depending on what your target audience is, whether it's probably a combination of online, TV, any ways that research indicates are effective. And finally, scalable. That means that there's a turnkey aspect to the program. If you just design a program and it only fits your needs and it can't be transposed to a larger scale, that's less desirable than one that would be scalable and that would translate to other areas, other regional areas. And then lastly, we come to the end of this long study. The statute required us to consult with FLEC and to come up with ways to increase investor literacy. So people in my office met with people from Treasury, Education, Labor, the Fed, CFPB, a whole long list, Social Security. I'm sure I'm leaving people out and I apologize. And they tried to come up with ways to build on the findings of the report. So in the first one, they want to develop programs to target those specific subgroups. Again, they're going to be mentioned by Seth. Try to get people to do a better job checking the background of their investment professional. 3, promote awareness of fees and costs. Really, it was one of the areas where investors had the least grasp. And then finally, promoting our own website, investor.gov, that is designed exclusively for the individual investor, but to try to add to the content by going to other government agencies and pulling their content into our site. And that, I should just point out, on the checking the background of the investment professionals, one of the things that we're thinking about is putting our ask and check button on other agency websites. So investors may hit that any of a number of different ways. I'm usually asked, what are the next steps? And my answer would be this. You'll notice that we did not make recommendations. We presented data. And the idea was that the data in all of these different parts of the study are to be used by policymakers to design better disclosure forms. I mean, some of them are SEC specific, and they will await action by the SEC in terms of whatever future rulemakings they want to do about specific forms. But the data, I think, could easily be used by other agencies or other groups as to the timing of disclosure of any sort and the formatting. And then we have more work to do on the coordinating with FLEC, and we will continue to do that. So those would be the next steps of the study. So, thank you.
I thought I'd open up the field for a few quick questions for Mary.
Mary Ryan Wilson with the AARP.
Oh, hi.
A question for you. You mentioned the broker check on FINRA, and you mentioned the investor and advisor check of the SEC's website. Is there thought of ever going forward, ever making those interoperable, again, with the state securities regulators so that people could check more easily if they don't know who's, what type of license their investment advisor writ
Sure.
broad has?
Well, and I can already report progress on that. Another of the Dodd-Frank assignments we had under 919B asked us to formulate recommendations to combine the information in the FINRA database, which includes both brokers and duly registered investment advisors. So because people are confused about which professional they're hiring, we recommended, and FINRA has, combined the database. So if you just go on FINRA or IAPD, you'll be able to find your person regardless of what capacity they are operating in. So
They still have the search function where you can look by area, so if you don't know somebody?
that was one of the additions, that to make it easier for people who are looking for an investment advisor in a particular geographic region, those pop up.
I'd like to acknowledge the contributions to my research of these three individuals. Anna Maria Lasardi is a professor of accounting and economics here at George Washington University, and she is responsible for the battery of questions that have been used over and over again in financial literacy surveys. Pamela Hurd is responsible for a survey I will be discussing during this presentation, and Lisa Schneider of Matthew Greenwald and Associates. The SEC Office of Investor Education and Advocacy commissioned us to write this report. It's not original research. It's secondary research, which is basically synthesizes existing research on this topic. And we've done previous reports for the SEC, the same office, but they dealt with behavioral finance. In other words, what do investors do? What mistakes do they make? And this topic was completely different. This is what do investors know? So this table summarizes the differences between the projects. There's a big difference between assessing what retail investors know and what mistakes they make. And if you're interested in our reports on investor behavior, they're also available on the SEC website. Another difference between the two topics has to do with the sources, because in this case, we were looking at investor surveys. They could have been implemented by any organization. It could be a company or a third-party organization, or an academic group. But in the case of the investor behavior, we focused exclusively on academic studies. And so in a way, that this topic is much more straightforward. And then we were told that the SEC was interested in certain aspects. Specifically, are there any differences in investor literacy among subgroups? Are there any research gaps? And what about fraud, including affinity fraud? Whereas in the case of investor behavior, we are dealing with behavioral finance and psychology. It was a much more academic topic. We considered 40 different financial literacy reports, but only 11 of these qualified because only 11 of them had actual quantitative surveys where some group went out and surveyed retail investors and asked them a series of questions having to do with the facts of finance. They would even ask people, how knowledgeable are you about this? And they would say, oh, we're very knowledgeable. And that was one of the findings that we had, is that people tend to overestimate how much they know. There's this huge disconnect between self-assessment and actual knowledge. Of these 11 surveys, 5 had to do with the general population, 5 had to do with these subgroups, and 1 had to do with investment fraud. This may be a little bit dry, but the mechanics of the report are a little bit important to me. The question was, how do I summarize so many surveys and make the report readable? I mean, people don't want to get bogged down in the verbiage of the questions. They don't have time. And so all of that has to be moved to the appendix. So in the report itself, what we have are a series of very concise tables. Each one is identical. Each identifies a series of questions by general topic and how many people answered correctly, how many people answered incorrectly, and how many people didn't know the answer or withheld a response. Then we analyzed the results, and the details were put in the appendix. So here's an example. And I'm featuring this survey because if you understand this survey, you understand most of the topic. This was the National Survey of Financial Capability by FINRA, and it consisted of these 5 topics. So now, for the people in this audience, you'd be amazed at how simple the questions are. They were very straightforward. And so it's surprising that that there was this level of incorrect responses. For example, for inflation, the question basically was, if you have a savings account and your savings account earns 1% interest, but the inflation rate is 2% interest, and in several years, will you have more in your account or less in your account? Or the same amount? I'm talking about very basic information. For bond prices, the question had to do with the inverse relationship between prices and yields for bonds. For compound interest, it had to do with, do you understand how much you would earn on compound interest? It's the 8th miracle of the world, and it's very important to understand how it works. And for mortgage interest, if you are comparing a 15-year mortgage and a 30-year mortgage, you know your payment will be much higher for the 15-year mortgage. Will you save the total amount of interest that you pay? And the answer is obvious to all of us in this room. And then for risk, it had to do with, are you safer in putting all your money in one stock, or would it be better to have a diversified portfolio? So we're not talking about rocket science. And yet, you can see that there's a considerable number of incorrect responses. Now, when it came to the analysis, we first just presented the results. And the answer was, the result is that out of the 5 questions, the average number of correct answers was 2.72. Men scored better than the women, for which there's no good explanation. Young adults are relatively inexperienced, so they didn't do very well. The adults in the age group 45 to 49 did the best, but then there's a big drop-off with the elderly population. This is important because it's the elderly population that decides how to spend their investment income. And not surprisingly, there's a correlation between your performance on these quizzes and on your income level, your educational level, and so on. And then among the ethnic groups, the Asian Americans perform the best, Hispanic Americans perform the worst. Now, what FINRA said about this was the obvious, and that is that the results demonstrate relatively low levels of financial literacy among Americans. And that is the main finding of the report. It's obvious, but there's more to it than that. And they do offer this additional analysis of the results of this particular quiz, this 5-question quiz, and they say that when you get down to the bottom, fewer than 10% of respondents were able to answer all 5 questions correctly. So most of the studies that we looked at were like FINRA. And so it's a lot of duplication. But the University of Wisconsin took a completely different approach, and I almost didn't include it in this report because I didn't want to include behavioral finance. I'm not interested in what mistakes they make or how they behave. I'm interested in what they know. But the University of Wisconsin tried to do that using a different approach. So instead of asking them about stocks and bonds and diversification things like that. They ask them, do you know how much money you have in your bank account? How much money you have invested for retirement? And the idea here was that if you don't understand your own financial situation, you're really not equipped to make good decisions. Now, the University of Wisconsin had a tremendous amount of data about a cohort of high school graduates from the 1930s. They knew everything about this group. They knew their IQ, they knew what their high school records were and what happened to them later in life, and they tracked them throughout their lives. So this is a perfect example of a longitudinal study. And what they found is that there's a correlation between low IQ and lack of exposure to mathematics courses in high school with difficulty managing finances later in life. And this has a policy implication. That's why I mentioned it. And that is that obviously there's a tremendous need for investor education in general for everyone. But there's a particularly acute need for investor education for certain groups. And that would include people with limited cognitive ability, because they're the ones likely to suffer the most. And as I mentioned, people tend to overestimate their capabilities and their knowledge. And so they may think they're very savvy and they're not, which is a problem. One good finding is that financial literacy increases with age, which is encouraging, until they become very elderly, and then that's no longer true. So women, the elderly, certain minority groups, and the poorly educated perform worse than average. And this is true across a series of different surveys, so you can see that these are not the same ones. And here's an interesting finding. You would think that fraud victims wouldn't score higher than non-victims on a financial literacy quiz, but guess what? Even they are susceptible to fraud. It's kind of amazing. An example of how the elderly are susceptible to fraud is that almost half of them believe that securities registered with the SEC are safe, and that's not true. I know the SEC is very interested in this topic, that only 15% of respondents check the background or credentials of an advisor with a regulator. And so the con artists are aware of this, and that's why they prey upon the young, the Southerners and poorly educated. Those are the key findings in terms of general knowledge, but then we've homed in on certain specific areas like fees. And only a quarter of the respondents knew that the classes of mutual funds vary by the level of fees they charge. And then there was the question of finding mutual funds that don't charge much in terms of fees. And 40% of older Americans didn't even know that this was a possibility, to find mutual funds charging less than 1% of assets. So what does that imply? It implies they don't know about the existence of index funds, despite John Bogle's best efforts at Vanguard. So that's a little bit concerning. And then no load versus load mutual funds. No load mutual funds do involve sales charges and other fees. Less than half of fraud victims knew that. And here again, the fraud victims outperforming the non-victims. So how can you explain that? I can't explain everything. Okay, key findings for risks. Despite the carnage at Enron Corporation and Fannie Mae, slight majority of correspondents, only a slight majority, knew that mutual funds provide a safer return than a single company stock. There's a pretty good figure for correlation between risk and return. And then the third point has to do with what happens to common stock in the case of bankruptcy, and that means, of course, the common stock is worthless. But only 60% know that. And then 39% were given a group of definitions of diversification, and only 39% selected the correct definition, which is balancing both risk and return in the pursuit of financial returns. There are research gaps. There are gaps in the literature about the root causes for why certain groups of population groups do not do as well as others. And women, it makes no sense at all. So there's no plausible explanation for it. And in fact, some researchers have attempted to address this issue, but they haven't come up with a plausible explanation yet. There was a survey done by the RAND Corporation in 2010, and in that survey, women underperformed by 0.7 standard deviations, which is fairly significant, but there's no reason for it. So one of the possibilities is there are different attitudes toward risk, and that's absolutely true. If you looked at behavioral finance, women are much more risk averse than men, and that might impact their answers to questions about factual things, about diversification and things like that. And then there are different ways in which men and women may become financially literate. There are different paths to this. So those are just very tentative explanations, and I would think that this is a very fertile area for researchers to explore this in more detail and find out what exactly is going on here. So I think I will move through the presentation a little faster than expected, but I hope you have some questions.
Hi, I'm Ann Marsteller from the Library of Congress. I work with Seth. There was a term thrown around of discipline, and the discipline that a person potentially receives. For what types of behavior is an investment manager disciplined? So when you look at their history, I mean, were they stealing millions? Did they, what would make them succumb to a disciplinary action?
Sure, a good question. They would be, could have been sanctioned, disciplined and sanctioned for violations of the Investment Advisors Act, or if they're a broker for violations of SEC or FINRA rules. It could range from trading ahead of the customer to not having the right paperwork, having defrauded a customer, just an infinite variety of misconduct that could end up with disciplinary sanctions. Well, some of them are by customer complaints. Other times, regulators do exams and inspections and enforcement actions and find it that way.
Hi, my name is Larry Giorgino. I guess I'm struck by I see this as very useful information, but it seems to have a missing component, and it's particularly unique to the investment area of risk. And that is, in neuropsychology, we see real differences in what they refer to as affective behavior, emotional intelligence versus intellectual intelligence. And in particularly in areas like finance, where risk is a fundamental concept, emotional behavior that influences how you understand data is, I would seem to be particularly relevant if we're trying to educate investors here. Understanding that aspect of this problem appears to have not been touched upon at all, either by your academic, searching, or by the SEC trying to understand investor behavior. Any thoughts on that issue?
I think you'd be interested in the whole area of behavioral finance, because in behavioral finance, they do go into psychology. And one of the topics is risk aversion. So there was Daniel Kahneman, the psychologist, who actually earned a Nobel Prize for his findings about prospect theory. And that's the idea that people are very risk averse. And the application to investing is that people are very leery about selling a losing security. And they don't know when to sell a winning security. So there are psychological reasons for this. So there is a vast area of behavioral finance, and if you read our other report about behavioral finance, then you'd probably be more satisfied. But for this report, we had a very specific topic. There are transfers. There are transfers. There's no doubt about it. I mean, men tend to be overconfident. And what I referred to before about not selling your losing position has a name. It's called the disposition effect. So it is being actively studied. And so I recommend you take a look at the other piece of research, because it includes an annotated bibliography. And so if you go to that, you'll see all kinds of sources, and you'll find out who are the leading scholars in this field. I mean, one of the people was a professor at University of California, Berkeley, Terence Odian, who's looked at this extensively. And he has very creative titles like "Boys will be boys," because they think they know everything, And does a very effective statistical analysis.
Diana Heyman, Department of Education. I'm interested in the services that are provided by the Library of Congress. Will these studies that you do for different agencies, are they all meta kinds of analysis? Do you conduct any research, primary research?
Well, the Federal Research Division is relatively unknown, first of all. If you look at research at the Library of Congress, everyone refers to the Congressional Research Service. So I usually get confused with CRS. But we are a very small unit, and what we do is customized research that is assigned to us by federal agencies, and it can be any kind of topic. And most of the time we are collecting and analyzing data, or often we are looking at foreign area studies issues for the defense agencies, Homeland Security, things like that. We might look into immigration. And so we write very detailed research reports. Some of them are available on our website, and some of them really belong to the customer. They don't want it made available to everyone.
Going back to this issue of risk and how it's portrayed to the investor, first I was really surprised that you showed that like the return risk correlation, that people understood that, because I have a really hard time believing that people understand risk, period, in some quantitative sense, but that's maybe reassuring. And I guess that's the thing too, when you do the disclosures and to show people, I mean, that's where I think the graphics become really important to kind of get a sense of like how much something can vary. But it reminds me of the fact, and also the diversification question, a lot of times risk isn't just in isolation. It's like what your whole portfolio looks like, what other assets you hold look like. And that's where I wonder, these disclosures or this focus on individual stocks that investors might hold, that kind of misses for them this like portfolio risk. And I mean, this just goes back to the economist in me, like for most of these small investors, actually maybe all of them, I don't understand why any of them are holding single stocks. And so we have this focus on, informing them about like particular stocks, and I don't know. So it's like how you show disclosure, how you show it in a neutral way, and like how that kind of even fits within what the mandates are of like the SEC, if they can do that more of a portfolio instead of a individual. So anyways, long question, sorry.
And I just wanted to add to that. So do you recall what the exact wording of the question was, where they looked at used to look at the relationship between risk and return? Is it just like, I have to accept higher risk to get higher returns, or?
That was a possibility.
Okay.
I agree with you completely. I think that even if you have a diversified stock portfolio, that's not diversified at all, because you have to be diversified across asset classes. And when it comes to the stock disclosure, it includes beta, and beta tells you the relative level of risk to the market. But you're absolutely correct, and most retail investors probably shouldn't be involved in owning individual stocks. So I'm 100% in agreement with you about that. And I think that should be part of it, investor education, that you tell people you really need to have a diversified portfolio, and it's not up to you to create one because it's too complicated. It's really a mathematical exercise. And so you're better off owning a variety of mutual funds and also different kinds of asset classes.
I would say that in the forms that we currently have, the disclosure of risk is narrative. How broad it is, I think, varies with the credibility of the particular advisor, and it's certainly incumbent upon an individual advisor or broker making recommendations to a customer that generally all risks be discussed and disclosed. Now, how that's done visually, it would just depend on the individual, but I take your point, and it's a good one.
So actually, just following up on that, so when you say risk, and when you talk about risk, there's a whole bunch of different risks you can deal with.
It's usually risk of loss.
Right, but
I know you're talking about it broader.
but it just in terms of disclosing risk of loss, like how you present that to the investor would really matter. Like, do you present it as there is a 1 in 10 chance that you will lose half of your investment, or is it just there is a chance your portfolio will go down in value, or is it?
Well, remember, in the securities world, we are formulating disclosures to be not misleading. So they will, I would think this is conjecture and it depends on the advisor or the other author of the disclosure, but they will have to include as much as they feel is necessary to avoid making a material misstatement or omitting a material misstatement of fact. So it's hard to answer your question. But the investor should be given as complete a disclosure as that advisor feels necessary at that time.
Mary, you mentioned that this study doesn't have recommendations. If taking off your SEC employee hat but putting on your Mary Head hat, would you?
That's risky.
Yeah. Might you have like one or two things you thought would work to improve disclosure? I mean, I could think of a few things myself.
Well, sure. I think to me, the key finding of the whole report was that people want information sooner than they're currently getting it. So I think we could do a lot in terms of trying to move up the time at which these investor disclosures are provided. I think following up on, it wouldn't be rule amendments necessarily, but sort of best practices to encourage advisors to discuss more of the contents of the summary brochure. Remember the example with the 18 items. I mean, that's a lot for people to. And remember, this is some boilerplate in its narrative. So until we move to a type of disclosure that's more visually based, and encourage, again, investment professionals to carry out their current obligations to make recommendations that are suitable for that particular customer. I think that's an area of, it's sort of a fertile area for rulemaking. As I say, I do think the timing is really the key.
Both reports taken together seems to me to suggest that people want more information and then they have no idea what to do with it once they have it, right? So is there any attempt to maybe try and communicate some of this information that individual investors seem to be lacking to them with these other materials that they're going to get, such as basic information on how bonds are priced or risk and return?
Right. Well, remember, some of the concepts that investors that the general public is lacking. The investors are sort of a subset of that, and they can be informed. I mean, my office tries to put on outreach events, and we do alerts and bulletins and all kind of campaigns, and the self-regulatory organizations like FINRA and organizations like AARP. Everybody is trying to educate the investors. Here's one thing we do. It doesn't quite address your point, but we have a program. We work with the Treasury Department to insert a little card every time someone sent a tax refund. Now, that's a population that's not online, okay? And it is a smaller population every year, but we try to put a message in there, how to contact investor.gov, and try to explain very, very briefly the kind of information they can get from us. But you have to make the people want to ask for the information. And that is part of the challenge. I mean, one of the things we would like to do, funds permitting, would be to, and they don't permit, but would be to do a public service announcement, like ask and check out the background of your broker-dealer. I mean, people could avoid a lot of problems if they did that. The other thing is to check out, use the SEC filings database to check out the investment. Is it registered? Is it not registered? Generally, more risk when an investment is not registered with us. So there are steps people can take to protect themselves. But the key is getting to the point where they realize that's important and they want to do it. I mean, some of them just don't want to take the time. And I understand, that's not a criticism. I understand why that is.
Just as a quick question, because TurboTax has been working with Duke, on their website. Have you ever contacted Quicken?
No.
because they've set up a website with Dan Ariely where they're doing behavioral economics, and they've started doing that where they can hit like 40 million people pretty easily, and he's going to be doing a lot of stuff. Dan Ariely, I mean, he's been sending his partner on the tour, of all the research
He
stuff.
spoke at the SEC not too
Yeah.
long ago.
Did either of your studies focus on insurance products in addition to investment products, life insurance? And I think I saw variable annuities up there as well. And were there perception or knowledge differences with insurance products versus investment vehicles?
Well, variable annuities are securities, not insurance, so they were included in the products that we used in the focus groups. Unlike the mutual funds and ETFs, there is not a summary prospectus for variable annuities, and that is a big area of investor confusion and potential harm. But those were the only products. We limited it to securities, not insurance.
Looks like Seth might have something if he's digging through a report.
We did have we did include in the survey the 2010 Northwestern Mutual Life Insurance Company's Financial Matters study. So, that included questions about the differences between disability insurance and group disability insurance, group life insurance, lifelong insurance, term life, and so on and so forth. So yes, that is part of the study, and you can find that in the report.
You spoke about a possible correlation between the education level and your. What education level do you need to do? Algebra 1, Algebra 2, simple arithmetic, or calculus?
Well, that's a very good question because it's very difficult to separate out quantitative skills from investor knowledge, because the question may be designed to determine whether you understand what inflation is, but it also requires you to do certain calculations. So that is true, and so that may be one area where the superior cognitive ability may tip the balance, and so someone who's very, very smart and doesn't know anything about finance may do very well on this quiz just because they can figure it out. So you're right.
All right. Well, with that, we can head on over to the reception. Thank you very much for coming, and if you could thank our guests.